How do commodity supply chain bottlenecks impact the economy? Imagine a world where the flow of raw materials suddenly slows down or stops altogether. That's what supply chain bottlenecks in commodities can do to the economy. When disruptions happen at any stage, extraction, processing, transportation, or distribution, they can cause big ripple effects. For example, if oil or metals face delays, it affects many industries that relying on these materials. Ports might close unexpectedly, or shipping containers could run short, delaying deliveries for weeks or even months. These delays push prices higher because demand outpaces supply. When prices for commodities like energy or grains rise sharply, it can lead to inflation, making everyday goods more expensive. Businesses then pass these higher costs to consumers, which can slow down spending and reduce economic growth. Supply chain issues also slow down manufacturing. Factories may not get the parts they need on time, causing delays in producing cars, electronics, or construction materials. This slowdown can cut into profits and make companies less willing to invest. Transportation costs are another big factor. When shipping routes face disruptions or demand for freight increases, transportation prices go up. These higher costs are often passed along to consumers, adding to inflation and squeezing profit margins for companies. Disruptions in industries that produce key inputs, like metals or semiconductors, have the biggest impact. If a shortage occurs, it affects many sectors, from electronics to automobiles. These ripple effects make it harder for businesses to plan ahead and can slow down overall economic activity. If bottlenecks last a long time, they can change how people and companies expect prices to behave. Persistent delays might push wages higher as workers demand more pay, which can further fuel inflation. Central banks might respond by raising interest rates, which can slow down economic growth and reduce demand for commodities. For investors, understanding these supply chain issues is vital. Sudden disruptions can cause quick price jumps, but they also bring more uncertainty. Monitoring shipping costs, inventory levels, and production reports can help predict when prices might rise or fall. Recognizing where bottlenecks are happening allows investors to adjust their strategies and manage risks better. In the end, supply chain bottlenecks in commodities influence prices, inflation, industrial output, and overall economic health. They can create both challenges and opportunities for investors who keep a close eye on how disruptions unfold and respond accordingly.